Hello, everyone. Welcome to video 5 of chapter 11. The first few videos we were focused on losses. This video, I want to talk about the capital gains deduction. It is a handful of slides, but in our discussion of losses and ordering of losses, this is a lower priority. So we won't go through any exercises of this numerically other than just the examples that are in the slides. And I would emphasize the other videos of this chapter to be of a higher priority for your studying purposes. But I do want to take a moment to make sure that we cover this specific idea of the capital gains deduction. So the capital gains deduction was first introduced in 1985, and what it did is it said everyone gets a certain amount of capital gains that they won't get taxed on. Everyone will get $100,000 of tax-free capital gains. That was its starting draft. After a couple years, I think they refined it to encourage a specific type of investing. Instead of being able to use this against any capital gains, this can only protect against capital gains from selling shares in a Canadian business that hopefully you started. So this is called a qualified small business corporation. These rules that we're about to go through are very similar to the allowable business investment loss because capital gains deduction is kind of just the other side of that very coin. So it's no longer $100,000. The amount of tax-free capital gains has been going up over the years. And in 2024, it just passed $1 million. So if you are an entrepreneur, you want to start your business, you think you can make it big, when you sell that business, and if you sell it for more than $1 million, you could protect yourself of $1 million of capital gains, or in other words, get $1 million of capital gains tax-free. So these deductions are indexed each year. And I know the government has declared intentions to get this number to 1.25 million, so 1.25. The deduction of $1 million for interest in qualified farm and fishing properties for dispositions after 2015, the amount for qualified fishing properties was to remain unchanged until the index limit for qualified small business corporations reached $1 million. So you notice that in 2023, this limit was 970,000. Well, during this time, the qualified fishing property was already $1 million. And it's been $1 million for a few years. So it's kind of been waiting for the small business index or threshold to catch up to it. And now I believe they are moving together. So this limit is available whether I'm selling a qualified small business or if I'm selling qualified farm and fishing. And they do share this limit amount. So however, in 2024, the annual increase to $1 million. The 2024 federal budget announced an increase to the lifetime limit of 1.25 million, effective after June 25th, 2024. So there's no indexing for the capital gains deduction limit in 2025 because we've got this lifetime limit to 1.25, but I think there is expectations for it to continue. So right now, the capital gains deduction limit is 1.25 million, 1.25 million. So the capital gains deduction is available on dispositions of qualified property. To be qualified, it has to be a share of a qualified small business corporation or interest in qualified farm property. Now, farm properties don't just include the land for farming. It can include the real property, fishing boats. Class 14.1 probably has specific quotas related to the business, and they must be used in carrying on farming or fishing business, either by you, the individual, or the individual's spouse or children. This includes corporation or partnership in which any of the individuals have an interest. This uses the same rules of small business corporation that we discussed for allowable business investment loss. It has to be a Canadian-controlled private corporation. Substantially all of the assets must be used in active business, And that active business needs to be primarily over 50% operated in Canada. The SPC status is modified for the capital gains deduction by special valuation rules for the 50 and 90% fair market value asset valuation. So that's saying the small business corporation for capital gains deduction follows the same rules as the ABLE, but the capital gains deduction has some minor adjustment to that fair market value calculation that can make it slightly harder to qualify for the capital gains deduction. To qualify for the small business corporation for purposes of the capital gains deduction, at the time of disposition, shares must be an SBC. For the allowable business investment loss, they just needed to hit that substantially all within a year of the sale. For the capital gains deduction, you must meet it at the time of the sale. Not only that, but your shares have to qualify for 24 months preceding the disposition. So you need to have an active business that's been running for at least 2 years. If my, so if not like, so let me rephrase this. Let's say I have my business and I have some excess cash that's been sitting. So now 90% of my assets aren't in active business. I can purify it, means I can partake in transactions to move those excess assets out, to pay out dividends, to get into the hands of shareholders so that I'm on side. I have my assets are now back to over 90% for active business. And then I need to hold that position for 2 years and make sure shares are not owned by anyone other than taxpayers. So I have to hang on to those shares for 2 years. If greater than 50% of fair market value of assets, use an active business carried on primarily in Canada. So for 2 years, I need that primarily in Canada. And then at the time of disposition, I need to be on side for 90% of my fair market value assets. So if we're on side, we qualify, how much can we use? Well, we've already mentioned that maximum deduction is 1.25 million, but you don't get that 1.25 million every year. Like if I can't protect a gain this year of $1 million and then protect another $1 million next year, it's a lifetime deduction. So in a given year, how much can I use? Well, first they figure out how much capital gains deduction do you have available? Let's say I have $1 million still available. So that's my one limit. The annual capital gains limit figures out, well, how much gains need to be protected this year? That's another limit. And then we have the cumulative gains limit, which means every time I use some of my capital gains deduction, I can't use that much again, which means so I had 1.25 million. In 1 year, I used $250,000. Now my limit's just $1 million. I start a new business. I use another 300,000. Now that limit's gone down to 700,000. So my cumulative gains, every time I use the deduction, it adds up. It's cumulative, and I can't use that much again. So the amount of deduction available is index maximum less any amounts claimed in a preceding year. So for 2024, we have that $1 million. The gains deduction available is complicated if individual claimed capital gains deductions in years with different inclusion rates. Capital gains have been included in income at 50% since the year 2000. So we're not going to throw much of this at you. But basically, if you have a gain in a year that has a different inclusion rate, back it out to its normal inclusion amount. So in 1988 or in 1990, the inclusion rate was 75%. So if I had, okay, here's $100,000 times 0.75, $75,000 was included in my income. And then I use the capital gains deduction to protect $75,000. To back it out, I would just divide it by 0.75 to get the total gain, and I would subtract that from my limit. So $100,000 being 1.16836. So now I have $916,000, which means I can protect 458,000 of taxable capital gains. So that's just the complicated thing. If we have amounts with different inclusion rates, just back out to the full capital gain that you're protected and then subtract it from our full limit. The AGL determined by formula A minus B. So A is the net taxable gains in the current year and modified amount dispositions from the qualified fishing property or qualified small business corporation. So the most I'm allowed to protect with the gains deduction is the lesser of total gains in the year and gains related to the small business corporation. Now, if the small business corporation is my only sale, then it is my total taxable gains in the year. So it just makes sure that you're only applying this deduction against the qualified small business corporation transactions. If I sold my company, so I have capital gains, but then I sold some shares that have losses. If those net losses are already subtracting against my qualified disposal, I don't need to use the full gain. I don't need to use the capital gains deduction to protect my full capital gain because some of it was already netted against some allowable losses. So that's what A's trying to figure out. A is how much of the capital gains did you recognize this year related to a qualifying small business? And then from that gain, we can subtract net capital losses deducted in year that exceed the formula in A and Abel's realized. That basically saying if I have a net capital loss, that's going to subtract from A. If I'm using any of my allowable business investment loss, that's also going to subtract how much of my capital gains deduction I can use. I said in a previous video that the Able and the capital gains deductions are two sides of the same coin. So if I used some allowable business investment loss, it also reduces how much capital gain deduction I am allowed. So if I have some Able this year, that's going to reduce how much of my deduction amount I can use this year due to my annual gain loss. The simplified AGL calculation. So if this formula is trying to figure out if I have my qualified small business disposal and other capital gains and losses. But if it's my only disposal, it's very simple. My capital gain on my qualified small business corporation shares, less allowable capital losses realized, less net capital losses used, less Able's used. So this gain is already being subtracted by these various these various capital losses. So I will only use my capital gains deduction on the amount that's left. The cumulative gains limit adds up all of my annual, current, and previous years, less capital gains deduction used in previous years. It also applies the cumulative net investment loss. Does it have a share on that? Sorry, maybe I'll summarize this slide first. So the cumulative gains limit adds up all of the allowable gains limit I had in the past and then subtracts from it how much capital gains deduction did I use. I was allowed to use 800,000 of gain. I've already used 600,000. I can only use 200, the difference, the remaining 200,000, right? The cumulative net investment loss comes into play is if I continuously have investment losses. So overall, all of my investments lost money, so they're sitting on my tax account to be used. They're waiting for me to have investment income to use up those losses. And then this year, I have a big capital gain from selling a small business. I want to use the capital gains deduction. I want to use the deduction and save these losses for the future. Well, the CRA says no. You can't use the capital gains deduction until your net investments in your life is positive. So you need to use up these investment losses first before you get that preferred protection. Now, if you've had investment income all your life and suddenly you have this big sale of a qualified business, you can protect as much of it as you can. But if your investments consistently have losses, they want you to use those losses before using the capital gains deduction. So that's basically what the cumulative net investment loss is. So the rationale reducing capital gains deduction, the government decided it was inequitable for individuals to have both deductible investment losses and still shelter capital gains by using the CGD. The cumulative net investments mostly looking at investment income after 1987, which is a long time ago. So pre-1987 losses don't usually come up in this day and age of doing taxes, except for people who have been investing for 40 years. So if I have some cumulative net investment losses, I would want to realize some of my capital gains early to realize my capital gains early before my net investments become losses. I can delay selling my qualified small business until I eliminate or reduce the investment loss. So, in other words, recognize some different investment gains to get that back to a positive position. And the owner managers can have corporation pay dividends or interest. Right now, I have a business that's making money. I can sell it for a profit, but I have some losses. Why don't I just declare some dividends, pay out some interest to me, the shareholder, until that balance gets positive? And then I will sell my company for a large gain that I can protect. Um, we're getting on the longer side of this, but I will just finish up with this example. I believe that's the end. Yes. So an individual has $20,000 taxable capital gain from disposing of a qualified business. $6,000 capital gain was realized in 2016 on a sale of qualified business shares. The capital gains deduction deducted in 2016 was the $6,000, right? We recognized a gain of 6,000. We protected it as much as we could. There's a net capital loss carry forward from 2018 of $9,000, which was deducted in 2024. The individual has a $3,000 cumulative net investment loss at the end of 2024. So the capital gains deduction available is the unused portion. So if in 2024 we had a little over $1 million, $1,016,000, half of that is 508,000. That's how much taxable capital gain can be protected. If we subtract the $6,000 that was used, remember we used it in 2016, there's 502,000 left that's available to us. Our AGL, our annual loss amount, is the $20,000. We had a $20,000 taxable capital gain from our small business shares, but we had a net capital loss. So we have to use that capital loss first. 20,000 minus 9 means only $11,000 is still left to protect. Our cumulative gain is $6,000, the amount we used in 2016, plus our annual limit now at $11,000. Sorry, we add up our AGL. So 6,000 from 2016 plus 11,000 from this year minus the 2016 amount used. So they will net to zero. So we have our AGL this year of 11,000 minus our cumulative loss of $3,000 means we can only use 8,000. So we have $500,000 available. We have an annual income amount, an annual gain of $11,000, but we can only use 8,000 of it because the cumulative amount is including the $11,000 minus our net loss over the years. Like I said, this particular subject I have to go through for you. It's of lower priority. I'm not doing any exercises for this. Hopefully you can follow the calculation, but I can't off the top of my head think of any questions where we give you the calculation to do. But please be aware of the rules on what makes a qualified small business because they are the same, the same or similar rules to that allowable business investment loss. The last slide for this section is the Canadian Entrepreneurs Incentive. This is a new rule for the 2024 budget. So it's a little beyond the scope of this course where we're trying to focus on those big rules that have been around for a while. So I'm not going to test you on this Canadian Entrepreneurs Incentive. We'll incorporate this as it gets a little more, I guess, more historical functionality. Okay. So that's the capital gains deduction. When we return, we will review our losses we were talking about before and considering in what order is the best way to use them. Thank you for your time. See you in the next video.